Example 5, fair value disclosure of debt and financial instruments. Now over here we have this consolidated, actually condensed balance sheet, and we only have liabilities here. Now we need to understand that the organization or the company at times disclose at amortized cost or at times at fair value. So out of these, from like deposits from banks, customer deposits, financial liabilities at fair value, other liabilities, debt securities. Now only this item, financial liabilities, is disclosed at fair value. All other items are disclosed at the amortized cost or carrying amount. Now let's go through the question. You can read the case, but this is the main point, that the organization at times disclose their liabilities at amortized cost or at times at fair value. Now the first question is, use 31st December 2017, what proportion of the amount of liabilities on ING group balance sheet is reported at fair value through profit and loss? Now the total amount of liability in 2017 is 794.8. Out of this, only 87.2 is disclosed at fair value. So the proportion would be 87.2 divided by 794.8, and that is 11%. Now we have this another set of data. Now if you look closely, in 2017 deposits from banks 36.8 in 2017 and 32 in 2016. Now this is at carrying amount, so we can see deposits from bank 36.8 and almost 32. This is coming from here. Now 87.2. Now financial liabilities at fair value consist of three items: trading liabilities, non-trading derivatives, and designated as fair value through profit and loss. So if you add them up, you are going to get approximately 87.2. And it is written over here that financial liabilities at fair value through profit and loss comprise of following subcategories, that is trade liabilities, non-trading derivatives, and other financial liabilities designated at fair value through profit and loss management. Now these are the subcategories. Part 2 says, as of 31st December 2017 and 2016, what is the percent difference between the carrying amount and fair value of debt securities that are shown on ING Group's balance sheet at amortized cost? Now over here, this is this data set deals with fair value, and this data set deals with carrying amount, and we are concerned with debt securities. So the question asks us about debt securities. So this is fair value and this is carrying amount. This is 2017 and 2016 data. Now what is the difference? In 2017, fair value is 96,736 million and the carrying amount is 96,086 million. So the difference would be 96,736 divided by 96,086, and this is the percentage difference. So it is 0.7, fair value is 0.7% more. And in 2016, the difference is, this is your fair value and this is your carrying amount. So the difference would be 103,559 divided by 103,234 minus 1. This is going to give us the percent change of 0.3%, that the fair value is 0.3% more than the carrying amount. For 2017, it was 0.7%. Example 6, debt extinguishment disclosure. Now just to brief you up, let's suppose the liability carrying amount is 5 million and cash paid to retire this liability is 2 million. So we actually have a gain of $3 million because we paid $2 million to retire $5 million liability. Now over here, the following reserves are from 2018 annual report of Montrock & Company. It is a statement of cash flow. The company uses indirect method to reconcile net income with net cash provided operation. Now this 3 million is a gain that will go to income statement, and we can see over here that there is gain on debt extinguishment of $2.35 million. And again, because this is gains are non-cash, so if we start from net income, we need to subtract gain on debt extinguishment in order to come up with the cash flow. Let's read the question. On December 12, 2014, the company issued 25 million of unsecured bonds. Interest on bonds is equal to LIBOR plus 4% payable quarterly in arrears. During the fourth quarter 2018, the company repurchased the unsecured debt with a face value of 4.5 million. So the face value or the carrying amount was 4.5 million and realized a gain of 2.3 million. And the gain was 2.3 million. Now the first question is the balance in bonds payable was reduced at redemption by. So when we redeem the bond, the liability will go down by 4.5 million. And how much cash did the company pay to redeem the bonds? Now this 2.3 million is actually 2.345 million. So we had a gain plus if the amount of cash we paid, this will equal to the face value. So we paid the gain was 2.345 and the face value is 4.5. So the cash that we paid would have been 4.5 minus 2.345, that is 2.155. And it makes intuitive sense as well, because if this is the liability that we are paying and this is the gain that we generated, it means that we must have paid a lower amount for something that is worth 4.5, then there's a gain. So if you are paying 2.155 for a 4.5 million liability, then the gain we would have generated would be 2.345. So how much cash did the company pay to redeem the bonds? So the gain again was 2.345 and the face value that we redeemed was 4.5. So we must have paid 2.155 so that we get a gain of 2.345. So for example 7, we have this company which has taken debt, and there are certain covenants over here, and you can read this yourself. So again, there's this company who has taken debt, and these are the covenants. So they have to maintain a certain level of ratios. So again, we need to understand there are two types of covenants. One is affirmative covenant and the other one is restrictive covenant. Affirmative covenants are your positive covenants, that these are things that you have to follow. And whenever you read the word not, so this would be a restrictive covenant. So over here we have to maintain certain ratios, for example loan to value ratio. So if at any time the aggregate market value of the vessel, so there's this company which world's largest carrier of refined oil products, so they carry oil on these vessels. So the market value of the vessels and the value of any additional security is less than 133% of loan amount, less amount on credit in the deposit accounts and reserve accounts, and the value of any additional security. The borrower and guarantor shall within 30 days of a written request post additional security to or repay the loan to reduce the excess to zero. So if you have to maintain this ratio of 133%. There's again another covenant. This is your liquidity. Now minimum unencumbered cash and cash equivalent of the hire, either you have 75 million or 5% of the total debt, of which 40 million is required to be in unencumbered cash and cash equivalents. So again, you need to have either 75 million or 5% of your total debt in cash. And then third ratio is your equity ratio. So the ratio of market value adjusted shareholders equity to total market value adjusted assets should be at least 25%. And the last one is dividend. We are restricted. Now this is your restrictive covenant from making any distribution, including payment of dividends and repayment of shareholders loan. Now first you have to pay back your debt and then you pay any dividends. So these are your covenants over here. And based on excerpt above, what are the potential consequences? So obviously if you are unable to comply with these covenants, so you will be declared bankrupt and you have to pay back your entire loan. Example 8. Exhibit 1 is an excerpt from Note 7 of Johnson & Johnson 2017 annual report that illustrates financial statement disclosure for long-term debt, including type and nature of long-term debt, carrying amount, effective interest rate, and required payment over the next 5 years. Now over here we have a list of bonds. So this 5.5% over here, it's a coupon rate. So we have effective rates. Now what is an effective rate? Effective rate is actually the market rate when the bond was started. At the time zero, or the market rate at time zero is your effective rate. So we have list of different securities. Now let's read the first question. Use the information exhibit 1 to answer the following question. Why are the effective interest rate unchanged from 2016 to 2017 for most of the borrowing listed? Now once the bond starts to pay, the market interest rate at time 0 is your effective interest rate. So effective interest rate doesn't change. Market interest rate, as time starts, market interest rate might go up and down, but effective interest rate was the market rate at initiation, so it doesn't change. The effective rate typically refers to the market rate at which the bonds are issued and typically does not change from year to year. Question 2. Why does the carrying amount of the 1.125% notes due 2019 remain the same in 2016 and 2017? So why does the carrying amount of this note remains unchanged? So let's see. So this is the bond that we are talking about. So the coupon rate is approximately 1.13% and effective interest rate in 2016 and 2017, so that's also 1.13. So when coupon rate equals to market interest rate, the bond is issued at par and the market interest rate remained at 1.13, and hence the carrying amount didn't change and still trading at par. So 699, the value didn't change because the market interest rate is equal to coupon rate, and whenever the market interest rate equals to the coupon rate, the bond is trading at par. So the carrying amount of the 1.125 notes due 2019 remains the same because the effective interest rate at which the debentures were issued is approximately the same as the coupon rate, indicating the notes were issued approximately at par. There would be no amortization of a premium or discount to affect the carrying amount of the notes, and assuming no repurchases, the carrying amount would not change. Part 3. Why is the carrying amount of 4.75 notes due 2019 higher in 2017 and in 2016? So this is the bond that we are talking about. So the coupon rate is 4.75% and the interest rate was 5.83%. Because interest rate is more than the coupon rate, the bond must have been issued at a discount. When the bond is issued at a discount, the carrying amount converges towards par. So at each point it is amortized and the value actually goes up. And hence we can see that the value went from 1041 to 1192, which is again converging towards par. And secondly, also the bond was issued at euro, and euro appreciated from 1.0449 to 1.1947, and because of this currency change there is also an advantage, and the carrying and the value of the bond went up. The notes are denominated in euros with the face value of 1 billion. The dollar euro translation exchange rate at the end of 2017 was higher than the exchange rate at the end of 2016. That increase explains part of the increase in carrying value. In addition, the effective interest rate was 5.83%, is higher than 4.75% coupon rate, implying that the notes were issued at a discount. Thus, the increase in the carrying amount of the notes also reflects the amortization of the issuance discount. And one very important thing is that the interest rate in 2016 and 2017 doesn't change. So the trajectory would be smooth towards par. So the trajectory that the bond is going to take would be smooth and it will going to converge towards par. Example 9. Financial statement disclosure of bonds with warrants. Now we need to find out that if all warrants were exercised, how many shares would be subscribed for. Now this is quite a complex question, and we don't just need to be bogged down onto this case, but still let's try to solve this question. So on 1st February 2018, company issued convertible bond with stock warrants due 2024 with an aggregate principal amount of 30 billion. So 30 billion is a principal amount. The bonds with warrants with fixed interest rate of 0.8% and interest payable annually were issued at par value of 100. So 30 billion divided by 100 will going to give us number of bonds. 0.3 billion bonds. 0.3 billion is actually 300 million, and Further on, each lot of bonds with warrants comprising 10 bonds with warrants. So 10 bonds make up a warrant. So number of warrants would be 300 million divided by 10, because 10 bonds when combined come up with one warrant. So this is 30 million. And to subscribe 50.5 shares, and warrants are entitled to the warrants to subscribe 50.5 shares. So 30 multiplied by 30 million multiplied by 50.5 would equal to 1,515 million. So this is our answer. So 1,515 million is 1.515 billion shares would be subscribed.